Hey everybody, Dave here, Hidden Freedom. Glad to have you back on another video. Today is Saturday, at least when you're watching this video. And today I'm going to be talking about an important topic that everybody probably thinks about or even does or has their own method of dealing with it. A subscriber reached out and basically said they're moving $800,000 out of a 401k into an IRA. And they're basically asking what's the best time to buy, QYLD, 20 other plus stocks, ETFs, and individual stocks. I don't know the specifics of this person. I don't know their age. I don't know, how much money they have on the taxable side, how much income they're looking to generate, or anything like that. So what I'm going to do is I'm going to basically respond to this as what I would probably do for my portfolio. So you can take what you want out of that, and obviously everybody is going to be in a different boat, and I'll talk about that kind of as we go on. In addition, I'll share my portfolio and kind of my thing that I'm going to be, because I'm going to be rolling over my 401k as well in just a few months. So I'm going to be basically going through the same thing, a little bit smaller amount than that, but in general, I'm going to be dealing with the same thing. So let's not waste any time. Let's go ahead and get started. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. So I'm recording this on a Wednesday, and by the time this video comes out, it will be Saturday. So guess what? There's 5 days left down here. Will be 90 days on Saturday. That means 3 months until I put my notice in and quit my job. And then shortly after that, go and leave to hike the Appalachian Trail. And then after I return from there, I will probably end up leaving the country and go and travel the world and slow travel the world. Make videos, of course, and I'll make videos on both channels because I do run another channel. If you're interested in seeing the other channel, please click on the link in the top right over there, and I'd appreciate if you support that channel. All right, so obviously there's a couple of unknowns here. I don't know the person's age, don't know how much income they want, don't know, how much of them the income they already have, don't know really, whether or not they have a lot of money on the taxable side. I mean, given the amount of money that they have on the tax deferred side, at least that they're rolling over, my guess is that they maxed that out, or they worked a long time. They maxed it out for a long time, or they worked for a long time. And because that's a substantial amount of money. Now, I didn't really pay much attention to the 401k over the years, didn't really care much about it. I always put the minimum in there to get the match, and that is something everybody should be doing, regardless if you think you can't afford it or not. You won't even know it's missing, and that's just free money you're leaving on the table. Back in the day, it used to be like 3% match. A lot of companies are doing more than that now. My company does 6%. Honestly, it's not really a true 6% because I only cap it at a certain amount, but a lot of companies will match you 3% no matter what you put in. If you're in a higher income bracket, then you can get a pretty darn substantial amount of match. So I always recommend everybody do that. That's 101. That's investing 101 right there. Why leave free money on the table? Same thing with an HSA, and I need to make a future video on HSA. And HSA, honestly, I wish I had one of those 20 years ago, because a $100,000 HSA would be absolutely perfect right now. I could generate, $7,000, $8,000 a year off of that. And guess what? You can pay your premiums, or you can pay your deductible with just an HSA off the dividends alone. But that's a whole nother story. That's a whole nother video. Okay, so this is my portfolio overview page here, and like I said, I will be sharing my portfolio at the end of the video. But I basically own a lot of the stocks that this person's going to be getting into. Now, granted, if you're not aware of my my channel and haven't followed it for quite a while, I started the dividend portfolio basically late 2019, or I think it was January 2020. So here we are. Basically, this portfolio is 2 years old at this point. And the portfolio itself is, roughly about 1.15 now. And I just I have that 401k that's going to get rolled over the IRA, which we're going to talk about here in a second. And not all this is investing in dividends. That's the reason why I don't even call it a dividend portfolio anymore. It's an investment portfolio. So I was focused on dividends most of the time, and then kind of got out of some of those and did various different strategies and all that because I didn't like the way things worked. And that's just the way investing is. Sometimes it doesn't work how you think it works, and then you need to modify the things on the fly. All right, so I do own all these individual stocks up here, as you can see. And obviously, those are some quality positions. When I started this portfolio, I had 30, 35 positions. I think I'm close to up to 40 at one point. And I dumped most of those, kind of left these ones here because I think these are pretty solid positions, pretty solid companies. And I like having that because these stocks up here in general should be a little bit lower beta. In general, I guess they should also hold up well, just like the recent tech wreck we've had. There's been a lot of rotation going on, and guess what? Things have been rotating out of tech, and they've been going into the Dow Jones stocks. And guess what? This was holding up pretty well. Granted, Microsoft and Apple weren't, but the rest of the stocks held up pretty well. So in that big down day we had on Monday, now I did get killed a little bit in the portfolio that day, but a lot of the stocks were up. It wasn't as bad as it really could have been. And that's what you get from the portfolio that I have because it's a hybrid portfolio. I got individual positions. I have, I'm going to be getting into QQQ, SCHD, SPY, and there'll be IWM here eventually. And then I got these income ETFs down here. And guess what? Every one of these encompass a different strategy as well, right? NUSI is a collar strategy. You got JEPI there. It's a little bit lower volatility stocks. It is a SP 500, and they're running an ELN in the background, which is about a 15 to 20% of the portfolio. We got DIVO, that is basically a solid position, about roughly 30 positions in there or so. And then they run covered calls opportunistically against those positions. And guess what? DIVO held out very well during that decline we had on Monday. XYLD, QYLD, they did not hold up well at all during the decline on Monday. It seems like the XYLD holds up a little bit better than QYLD does, and that kind of makes sense. It's not as volatile as the tech stocks. Plus, right now, the tech stocks, everybody is rotating out of them because the bond yield's going up and treasury yield's going up, or whatever you want to call it. So, we had a little bit of recovery on Tuesday, and today was Wednesday, a little bit of recovery today as well. So I like the hybrid strategy. Okay, now for me, that makes sense. Not everybody's going to be in the same boat that I'm in or this other person is in. They might have 20 or 30 years left to go. And I would recommend they just, pretty much just invest in the SPY or the SCHD. I'd go into a lower cost index like VOO or something like that instead of SPY, or even VTI, which encompasses all of VOO. If you got that much time left, don't even mess around. Just get into something that's solid. You don't got to put much thought into it, and you can just have your check go in there. And obviously, I think most retirement plans offer some sort of broad index. It's usually an SP 500 index, and that would work perfectly fine. Stay away from the target date funds. And honestly, stay away from a lot of the other junk that's in those, Vanguards or Fidelity retirement plans, because a lot of it is junk. So what I would do is put most of the money either in a broad index like an SP 500 index or a large cap, and then I'd put maybe a portion of that into mid cap, and then a little bit smaller percentage into a small cap. And if you really want to, you can maybe just put 5% into an emerging markets or something like that, but it's not really necessary. And I would not have any bond position at all. I have 0 bonds right now in any of my portfolios, and I have a lot of different accounts. And NUSI really is my bond position. So that's got a collar strategy, and that's kind of my rainy day, black swan event ETF that I own because it has those protective puts. And I know somebody just recently mentioned Swan as well, and I'm not a big fan of Swan personally, but NUSI works for me. So that's the best method, I believe, for younger people. You got a lot of time left, and when you basically contribute every month, it's $1 cost averaging for you. and make sure that you have your money that's being coming out of your check, and then you have the match being matched as well. And it's being spread across all of your elections properly. And maybe at the end of the year, just double check and look at that, and also look to see whether or not you need to rebalance or something like that if something got out of whack. So, all right, that takes us to what else should a younger person do? And obviously, in my opinion, and now granted this might be an unpopular position, but I think that people need to invest not just through a 401k or a Roth IRA or a Roth 401k. They should be investing money after tax as well. Okay, now over the last several years here, I've invested a ton of money after tax. Okay, so that means after money's already hit my bank account. The money's already come out for the 401k. The match is already there. It's already going into my 401k. But after the fact, I've been investing for several years now, 60 to 70% of my take-home pay. Now, granted, I get that. That's not always possible for everybody. If the older you get, the more money you should be making, and that will become more reality for you. You should be able to do it, and you should be able to max your 401k out. But the 401k is just a tool. If you're in a higher income bracket, then I think the 401k should be maxed out. If you're not in a higher income bracket, put the minimum in there at least to get your match, and then maybe put a little bit more in there if you want, but it is not the end all be all. If you want to retire early, you really need to think about getting money outside of the 401k and start building up a brokerage account. Okay, so I have a brokerage account here. It's got $686,000 in there or so, and then I have a bunch of real estate notes on the taxable side as well, and then I have this options account. So this is not the full amount, but 2/3 of my money is outside of retirement accounts. Okay, now I only have 1/3 of my net worth in retirement accounts, and I'm going to retire early. And if you're going to retire early, that is something you need to think about. You don't need to think about it right now, probably, but you're going to need to think about it 5 years maybe before retirement, and make sure you start building up your brokerage accounts. Okay, so that takes care of the younger people, in my opinion. Stay away from these income funds down here. You don't really need them. SCHD is fine. VTI VOO is fine. VYM, DGRO, those are probably fine. If you want to get some individual dividend stocks like these up here, those are fine. But in general, you probably just do perfectly fine, if not even better than most people, if you just stayed in VTI or VOO. There's no reason to be in both at the same time, because VTI encompasses all of VOO. All right. Now this brings me to a different scenario, right? The scenario that such person that asked the question in email of rolling over 401k with a large amount of money in it. Now, when I started this portfolio, it started with $50,000 in the portfolio. I had a lot of cash on the sidelines at that time, and I was looking to get invested slowly but surely. And that might not be the right way to go for some people, but when you get older, you'll understand this. When you get older, it's all about capital preservation first, and then second comes growth. And I'd say right mixed in there somewhere is income as well. You care about income, you care about a little bit of growth, but you care about capital preservation. So that is not something that should really be on a younger person's mind. So that kind of just, negates that whole conversation, because I hear that all the time. And so that's kind of the reason why I get into a lot of these different income funds down here, because they all have different strategy. Some are going to be more growth. Some are not going to have any growth at all. Some are going to just be straight income. Some are going to have income but a little bit of growth, and maybe be a little less volatile, which is the holy grail, which I talked about last video. Those three things right there: growth, income, and some sort of kind of hedge and or less volatile than the overall market. That is about the best of the three worlds. And most of them don't ever touch that. Most only touch two at one time: growth and maybe income. Some might touch just growth, and that is it. Some might just touch income and no growth and no protection at all. So some really honestly basically just have one. And like QYLD, for example, has no growth, has no downside protection, and it's just income. XYLD is a little bit less volatile, I'd probably say, than QYLD is. but it has a little bit of growth there and some income. Okay, all right. DIVO is most all income and a ton of growth as well, and even has a dividend growth as well. So that's something you get out of DIVO. NUSI is basically pretty much flat. Doesn't go up much, but JEPI is kind of the best of all three worlds in my opinion. So what would I do? Let's go to another page here because I've probably looked at this page until nauseum. And let's just go to the tools page here because this kind of explains more about what I want to do. I've done a complete video on this web page or Google Sheets page. I'm not going to really talk a lot in detail about this here, but this here is the taxable side. This here is a retirement account. This here is a retirement account. All right, so in a few months here, I'll be rolling over roughly about $400,000 out of a 401k into an IRA. And those will not be invested in any stocks at that point. So I'm going to kind of take this person saying, okay, he's going to invest $800,000. And this is what I would do if I had $800,000. In my case, it's going to be $400,000. What I'm going to be doing, and this might not be for everybody, I don't know. This is, not everybody's cup of tea, but I'll probably be selling puts against the SPY and the IWM. And roughly about 10 to 15% down if I can get down there. And if I get assigned, I get assigned, and then I'll probably just wheel it and sell covered calls against it. If I have like an odd amount of money in there where I can't get a whole nother contract, then what I would probably end up doing is just putting the money in there into that position anyway. That way I can have some growth out of it and kind of remain somewhat invested as much as I can. But over the years, over the last 2 years, I've had a lot of windfalls from various investments that either paid back early or I had 2 foreclosures that closed and I got the money back on those. So there's 2 times there I sold a rental property, got $200,000 for that. The 2 foreclosures got roughly about $190,000 back on that. I actually had some real estate notes that paid back as well, like $60,000 or $70,000. So I've had a lot of windfalls along the way. And I did not lump sum invest any of that money at all. What I did is I ended up buying, roughly about $30,000 a month and kind of spread it out over a couple of months. And looking back, 2020 and 2021 were amazing times in the market. Yeah, we had that decline in February, March of 2020, and I took advantage of it because I had a lot of cash on the sides at the time because I had just started the dividend portfolio. I had a lot of cash kind of waiting around, and I think I played it perfectly, put most of that money to work in March of 2020. February, March of 2020, put a lot of that money to work, made some great gains out of that money as well. And then when I got those windfalls, it was just it was not really opportunistic times to put that money in during the years. So I just kind of spread it out, 30,000 over this month, 30,000 over the next month, and just didn't lump sum invest it. But obviously going to look back on that, right? Lump sum is what I should have did, right? Because look at how well 2020 turned out and how well 2021 turned out. Now, you could say the market is at all-time highs right now. And if we look here at my Interactive Brokers platform, we can kind of see, this is the Qs. We're not, that far off the highs right here. It's at just about 2 or 3% off the highs or something like that, 4% off the highs. And if we look at the SPY, that's even less off the highs right now. And we're also having, look at that there. It's a lot, 1.5%, 2% off the highs right there. The SPY is. So in my opinion, the market is at toppy right now. So I would not feel comfortable just taking that $400,000 and then just putting it right into SPY and IWM at the tip top high. But that said, I have other income. This is my taxable side here. With options in there, I'm generating almost $8,000 a month. Including the options in there. If I took the options out, I think it drops to like 6 or something like that. So yeah, roughly about $6,000. So, I have about $6,000 coming in. And so I don't really need this money over here, So I think for me, it makes sense for me to sell cash secured puts, 7 contracts up here, maybe 3 contracts against IWM, roughly about 10 to 15% down. Try to get a discount on that purchase. It gets down there. If we have like a 20% pullback, then guess what? I'll get assigned 700 shares of SPY, and then I'll be invested quite heavily at that point. I can turn around and sell covered calls against those. If they get called away, so be it. As long as I don't, go basically under estimate it too much and miss out on the upside. Then I think I can churn about $20,000 of income on this account alone, and roughly about $5,000 to $7,000 of income on this account, just kind of wheeling the Qs. And that's a lot of money, and if I end up, Rule 72 SEPing that account there and kind of try to get some money out of that. I've talked about that in another video. I'm not going to talk about it into too much detail in this video, but that's kind of a plan to get some money out of this, to build a Roth ladder, and to kind of maybe even do a Roth conversion in this account, just to reduce that account till I get up to where basically I want to try to reduce it before RMDs start, to be honest with you. But I think for me, this makes the most sense. Okay, now could I just lump sum invest into a bunch of ETFs and a bunch of individual stocks? Certainly, absolutely. He could as well. This is the reason why it was hard to respond to this question, because I'm going to probably do something than most people. Most people probably don't want to mess around with options. And a lot of people, they might need that income right now. I don't know. If you're 59 years old or something, maybe you need that income. I don't know. I don't know this person's situation. Maybe they don't have any income over here. Maybe they're close to being 59. Maybe they need that money, that income coming from over here. That makes sense then, right? I'm still going to be generating income, but it's not guaranteed income. For me, my plan over here is to try to get a discount, 15 to 20% down, 10, 15, 20% down, discount on those stocks, get into them then, and play it that way. This is my way of making money, but still waiting to get a major discount on the overall market. Now, I don't think we're going to have a pullback, but we could. This is challenging times. Looks like good old Powell is going to be raising interest rates here up maybe 3 to 4 times this year. We got the bond yields going up like crazy. Mortgage rates just hit 3.5, 3.6%. Major run in the mortgage rates there. And guess what? It's definitely challenging. A lot of stocks, there's a lot of rotation going underneath the scenes there. So I think that it could be a challenging times, and I don't think the Fed is going to invert the yield curve, but I'm just going to play it safe. I care about capital preservation first for me, and then I care about growth, and I care about income equally probably after that. So for this person, I would say, dollar cost average in if you want. If you don't need the income, you can play the options if you want as well. It's another good way to get a discount on the stocks immediately and make income. Or you could even do maybe half and half, take $400,000, get into the stocks that you want to get into, start the positions. That way you're not missing out on growth. You even had some dividend income coming in and all that. And then if something pulls back, then you can deposit the rest across all those positions if you want. Or you could play it by getting $400,000 into there, spread across to maybe some more defensive plays, if you want to call it that, and then wait for things to drop, and then you can get into the more aggressive plays. Or you could play it in a different way and say, okay, I'm going to get into $400,000 worth of all these 20 positions, and then I'm going to play options on the rest of the $400,000. There's so many different ways to skin this cat here. So it's very tough for me to answer this question for this person because I don't know all of the circumstances around his accounts, his investments, and his goals, and his time horizon, and all that stuff. So that's the reason why I answered it as best I could for what I would basically do. And I've pretty much dollar cost averaged the last 2 years in this entire portfolio. And honestly, looking back, it was the wrong move. But that's what happens when you're getting close to retirement. You care about capital preservation, and you're not going to worry about trying to catch a discount on the stocks or catch a low, which nobody can do. So for me, it ended up being the wrong move because the stocks just, went almost 30% last year. Now, I was pretty much almost all invested last year, almost all of last year, so I took advantage of it. But still, if I had just taken every windfall that I got over the last 2 years, and that was a lot of money, by the way, I would have been better off in just putting the money in the market immediately and not waiting around. So, right now, I mean, who knows? I'm just all those things. I said the market's toppy. I said the market, I mean, we just looked at the market here. We just, we're close to the highs, right? I said the same thing about the Qs and all that, right? And the Russell's still down, but so here's Russell here. But so what I said is, who knows? I mean, the market could just turn around tomorrow and go up and make major new highs. You know what I mean? That could happen. I don't think it's going to happen. I think we still can make new highs this year, which we probably most likely will. But I don't think it's going to have a major run this year. But I could be wrong. You know what I mean? So that's the reason why I'm going to play it the way I'm going to play it and just be a little bit more defensive. And for somebody that's younger, that's not something they should really even have to think about. All right. I kind of told you I would go ahead and talk about my portfolio. So let me just show you my portfolio here, just in case you're curious. So there's all the positions here. SCHD, I'm going to start building out SCHD because it has a decent dividend yield, but it has some really good stocks in there. It's not a bunch of positions, not a ton of positions. And it also has a great dividend CAGR as well. So that will get built out. QQQ will get built out. I'm running actually 2 cash secured puts against Qs right now in that particular account. That is the 401k, the solar 401k. So there it is. Just a little bit of capital in there right now. And then I got 2 cash secured puts. That's roughly about $800 of income. And if I scroll down here, here's all the income ETFs down here. The SPY Spider. The SPY Spider is something I'm going to be continuing to build out as well once I roll the 401k over, roughly around April timeframe. And that will get rolled over to an IRA at Schwab as well, which is sitting over here. So there's a lot of cash sitting in that account right now, getting ready to roll it over. And then we have, QYLD right here, roughly about $50,000 in there. XYLD there, roughly about $50,000. NUSI about $150,000. We got JEPI there, $160,000, and then we got DIVO there about $160,000. So I'm going to continue to build out JEPI and DIVO first, and then the rest are pretty much where they're going to be. I'm not going to really build out NUSI anymore, or QYLD or XYLD. So as it stands right now, roughly about $114,000 in individual stocks, and then roughly about $585,000 in ETFs. So here's my schoolie fund here, which got $6,000 in it. I'm going to scroll down here. We got RYLD in this account, $2,000 in that. I got BST there, $2,000 roughly in BST. And then you got QQQM in there because you can't do options in M1. So I figured why not get in a little bit cheaper thing to own, which is QQQM. For roughly about $2,000 in there. And if you're not aware, M1 is doing an amazing deal right now. If you open an account, and deposit $100, you get $50 for free. I get $50 for free. That's an amazing deal. It goes all the way until the end of March. They extended it. So take advantage of that while you can. Get that $50 for free just by opening your account. So hopefully I answered the question there for this person. There's so many different ways to skin that cat there. You can dollar cost average in. You can basically just lump sum invest it if you want, and it's just very tough. It's a mental game, but in general, there's been a ton of studies done on it. Lump sum investing is the way to go, hands down, especially if you're young. So the younger you are, the more likely that is, or the better outcome that is. You should lump sum invest. And then for somebody that's my age or getting close to retirement, you might want to have a different strategy. And I've talked about those strategies in this video. So I'd love to hear what you would do given your circumstances. And leave the comment down below on what you would do. So if you have any comments, questions, concerns, leave a comment down below. Until next time, please go and like and subscribe. We'll see you in the next video. Thanks for watching.